Something strange is happening in the silver market, and the reason most people don't notice it is because they're looking in the wrong direction. They're watching future screens, scrolling price charts, waiting for confirmation from markets that no longer control the asset they're trying to understand. Meanwhile, the real signal isn't blinking on Western terminals. It's coming from the physical trade routes quietly redirecting metal eastward. This is not a rally driven by excitement. It's not a meme cycle. It's not speculative heat, it's pressure. The kind that builds when supply chains tighten, and nobody can relieve the tension without breaking something. The simplest way to see it is through one number: the gap between what silver costs in Shanghai versus what it trades for in New York. That gap has blown past $20 per ounce. Not a rounding error, not a shipping premium, a structural divergence. In any normally functioning market, a spread that large would be arbitraged away instantly. Metal would flow until prices converged. That isn't happening. And when arbitrage stops working, it means one side of the market doesn't have the inventory to respond. That is the condition silver has entered. Shanghai isn't paying a premium because traders are emotional. It's paying a premium because buyers there need the metal and cannot source it at scale through the existing system. The West, on the other hand, continues to quote prices based on paper volume that assumes availability. Two different realities are being priced at the same time, and the gap between them is widening. This tells us something critical. Price discovery has fractured. For decades, silver's price was set primarily through derivative markets that allowed massive volumes to trade without requiring physical settlement. That system only works as long as physical supply remains abundant enough to backstop confidence. Once confidence cracks, paper pricing loses authority. We are watching that crack form in real time. China's vault data confirms it. Inventories that once appeared stable have collapsed. Not gradually, not cyclically, but violently. Silver has been pulled into industrial use, strategic stockpiles, and private accumulation that does not recycle back into the open market. At the same time, demand from technology, defense, energy, and infrastructure continues to rise. That combination creates a one-way pressure system. Silver is leaving circulation faster than it can be replaced. And the refining choke point matters more than most people realize. China controls the majority of global silver refining capacity. That gives it leverage not just over supply, but over timing. Even if silver exists in the ground elsewhere, it must pass through controlled channels to reach market-ready form. When those channels tighten, delays ripple outward. This is how shortages form quietly before they show up in headlines. What makes this moment different from previous silver cycles is that monetary demand is re-entering the picture. At the same time, industrial demand is accelerating. Historically, silver experienced either one or the other, rarely both. That balance has now shifted. India's decision to formally integrate silver into its banking framework is a signal most Western analysts are underestimating. When a nation moves an asset into collateral status, demand becomes structural. It's no longer optional. It becomes embedded in credit creation. Millions of people begin interacting with silver not as a trade, but as a financial foundation. Once that happens, supply dynamics change permanently. At the same time, the paper markets continue to trade volumes that dwarf real production. Billions of synthetic ounces change hands daily with no intention of delivery. That imbalance only works while confidence remains intact. Once participants begin asking for metal instead of settlement, the illusion breaks. And we are seeing early signs of that break. Periods of zero delivery are no longer theoretical. They are occurring. Paper volume masks the absence of physical movement, but it cannot replace it. The moment physical demand accelerates, paper pricing is forced to chase reality instead of dictate it. This is why attempts to suppress price through short-term mechanisms are becoming less effective. They still cause volatility. They still generate fear, but they also accelerate transfer. Each forced dip invites physical buyers who are not sensitive to short-term price movement because their motivation is supply security, not speculation. That distinction matters. Speculators sell when charts break. Industrial buyers buy when inventory runs low. Monetary buyers accumulate when confidence erodes. Those three forces now point in the same direction. This is not how bubbles behave. Bubbles are driven by enthusiasm. They collapse when enthusiasm fades. Structural repricing is driven by necessity. It doesn't reverse just because sentiment shifts. That's why extreme price targets are being discussed seriously. Not because silver is suddenly magical, but because its prior price reflected decades of artificial supply created through leverage. Remove artificial supply, and the clearing price recalculates rapidly. Repricing events are never gradual. They happen in steps, gaps, and resets. The biggest mistake people make during transitions like this is assuming the past defines the future. They look at silver's history of suppression and conclude it will always be suppressed. That logic fails when the structure enforcing suppression loses credibility. Paper markets require trust. Physical markets require delivery. We are moving from a trust-based pricing regime to a delivery-based one. That transition creates discomfort because it exposes fragility. Liquidity dries up in unexpected places. Dealers hesitate. Spreads widen. Volatility increases. None of that means the thesis is broken. It means the system is adjusting under stress. Those who expect calm during structural change misunderstand how markets work. The question is no longer whether silver is undervalued relative to history. The question is whether the system pricing it can survive sustained physical demand without inventory. Every data point suggests it cannot. This does not mean immediate resolution. These systems resist collapse. They stretch, they distort, they delay, but pressure continues to build, and pressure eventually resolves through price. Silver is not moving because people want it to move. It is moving because the world needs it and cannot produce enough of it fast enough under the current framework. That is the story most charts cannot tell. As this pressure builds, something else starts to change that most people don't notice until it's already advanced. Liquidity begins to behave differently, not just in price swings, but in availability. You can still see quotes on screen, still see volume reported, still see contracts changing hands, but the ability to convert those numbers into actual metal starts to degrade. This is where paper markets quietly lose credibility. In healthy markets, liquidity tightens gradually. Bid and ask widen slightly. Settlement times lengthen modestly. In stress markets, liquidity disappears asymmetrically. Buyers remain aggressive, but sellers hesitate. Dealers pull back. Inventory becomes something you protect rather than trade. Silver has entered that phase. What's important to understand is that this is not caused by fear alone. It's caused by mismatch. Too many claims chasing too little metal. When that happens, the market stops behaving like a market and starts behaving like a rationing mechanism. Those rationing signals show up first in places most investors never look. Delivery delays, premiums that refuse to compress, geographic price divergence that persists instead of closing. All of these are signals of structural strain. This is why the East is becoming the center of gravity for silver pricing, not because of ideology, but because that's where physical demand intersects with settlement reality. Buyers there expect delivery. They plan production around it. They do not accept cash settlement as a substitute for material input. Western markets evolve differently. They optimize for liquidity and leverage, not delivery. That model works well until delivery becomes essential. Once it does, the advantages reverse. The result is what we're seeing now. A market where quoted prices exist everywhere, but meaningful supply exists only in specific locations. That creates a hierarchy of pricing authority. The price that clears physical demand becomes dominant. Everything else becomes reference noise. This hierarchy shift is subtle at first. Then it accelerates. And when it accelerates, participants who rely on historical correlations get trapped. They expect silver to behave like a hedge, like a trade, like a cyclical asset. Instead, it begins behaving like infrastructure. You don't trade infrastructure casually, you secure it. This is why volatility increases rather than decreases as the thesis strengthens. Every attempt to push price lower runs into immediate absorption by buyers who are not price sensitive in the short term. They care about continuity of supply, not entry precision. That absorption doesn't show up cleanly on charts. It shows up in warehouse flows and export data and refinery utilization. It shows up in how quickly metal disappears once it becomes available. This is also why dismissing this move as speculative misses the point. Speculation creates excess supply when prices rise. Producers hedge, sellers emerge. Silver is not seeing that response at scale. Production cannot ramp fast enough. Recycling is limited. Strategic stockpiles are not coming back to market. When supply cannot respond, price becomes the only adjustment mechanism. That mechanism is violent because it has to compensate for years of artificial suppression and delayed investment. Silver has been underpriced relative to its utility for a long time. Catch-up does not happen linearly. At the same time, monetary dynamics are adding fuel. Currency confidence is not collapsing all at once, but it is eroding persistently. Debt loads are growing faster than income. Fiscal responses rely on expansion, not restraint. That pushes capital toward assets that cannot be diluted. Silver sits at the intersection of necessity and scarcity. That combination is rare. Ownership clarity becomes critical in this environment. Holding something you cannot take delivery of is not the same as holding the asset. Exposure is not ownership. Claims are not control. As pressure builds, the system begins to differentiate between those distinctions aggressively. Those holding real metal experience inconvenience and volatility. Those holding paper claims experience counterparty risk. The difference is subtle until it isn't. This is not a call for urgency. It is a call for alignment. Aligning with how the market is actually functioning rather than how it is reported to function. Silver's story right now is not about upside alone. It is about transition, from synthetic abundance to physical constraint, from trust-based pricing to delivery-based pricing, from speculation to necessity. Transitions are uncomfortable. They challenge assumptions, they punish complacency, but they also reward preparation. Those who understand that silver's movement is being driven by forces larger than sentiment are less likely to panic during volatility. They recognize drawdowns as transfer points, not failure points. And as this process continues, the market will increasingly separate participants who understand the structure from those who react only to noise. That separation is already underway. As this transition deepens, the most important shift is psychological, not numerical. Markets don't break when prices rise. They break when confidence in the mechanism behind those prices disappears. That is what the silver market is quietly approaching. For decades, participants trusted that quoted prices reflected a balance between supply and demand. That trust allowed leverage, paper trading, and synthetic exposure to flourish. But trust is fragile when it's not reinforced by delivery. Once participants begin to question whether metal is actually available at posted prices, behavior changes rapidly. We're already seeing that behavior change. Buyers are less concerned with timing and more concerned with certainty. Sellers are less willing to part with inventory unless absolutely necessary. Intermediaries become cautious, widening spreads and reducing exposure. The market slows, not because demand weakens, but because confidence in settlement erodes. This is how price discovery migrates. It doesn't move because someone announces it. It moves because participants follow the path of least risk. If one market offers reliable delivery and another offers only financial exposure, capital flows toward the former. Over time, that flow becomes structural. That structure is now forming in silver. What makes this moment different from previous squeezes or cycles is scale. This is not a single region accumulating metal opportunistically. It is a coordinated draw across industrial, monetary, and strategic layers. Each layer reinforces the others. Industrial demand removes silver permanently from circulation. Monetary demand stores it long-term. Strategic accumulation centralizes refining and processing capacity. Together, they compress supply far more effectively than speculative buying ever could. This compression explains why price reactions feel disjointed, why drops are shallow, why rebounds are fast, why physical premiums persist even when screens suggest weakness. The market is telling you that price is no longer the primary clearing mechanism. Availability is. That distinction matters. In markets governed by price, volatility creates opportunity. In markets governed by availability, volatility creates anxiety. Participants stop optimizing for return and start optimizing for access. This is why attempts to frame the current move as a bubble fail. Bubbles require excess supply and easy exit. Silver has neither. Production cannot respond quickly. Substitution is limited. Recycling is constrained. Stockpiles are already thin. These are not bubble conditions. These are bottleneck conditions. Bottlenecks resolve in only two ways. Either demand collapses or price rises enough to ration supply. Given silver's role across energy, defense, and technology, demand collapse is unlikely. That leaves repricing. Repricing does not ask for consensus. It happens because it must. And when it happens, it often overshoots, because the market has to compensate for years of misallocation. This is where many participants make their mistake. They wait for confirmation that arrives only after the opportunity is passed. They wait for validation from institutions that benefit from delay. They wait for price stability in an environment that is structurally unstable. Meanwhile, those closer to the physical market act quietly. They secure supply. They reduce exposure to claims. They position for continuity rather than performance. This divergence in behavior is the clearest signal you can observe. It tells you who understands the transition and who is still trading the old regime. Silver does not need universal belief to continue this process. It needs only continued scarcity and consistent demand. Both are already present. What remains uncertain is timing, not direction. And that uncertainty is precisely why preparation matters more than prediction. You do not need to know the exact price path to understand the structural forces at work. You need to recognize when a market's rules are changing. They are changing now. This does not mean every participant must take the same action. It means every participant must understand the environment they are operating in. Exposure that made sense in an abundant system may not make sense in a constrained one. Ownership clarity, counterparty awareness, and supply chain visibility become more important than chart patterns and sentiment indicators. This is a shift away from trading and toward positioning. Silver's role in that shift is not accidental. It sits at a unique intersection of necessity, scarcity, and monetary history. It has been undervalued not because it lacks importance, but because its importance was inconvenient to acknowledge. That inconvenience is no longer sustainable. As physical markets assert control, narratives will lag. Commentary will catch up only after outcomes are obvious. By then, decisions become reactive rather than intentional. The advantage lies with those who understand the transition while it is still unfolding, not because they expect perfection, but because they respect structure. This moment is not about chasing price. It is about aligning with reality. Reality is that silver is becoming harder to source, more strategically valuable, and less responsive to synthetic pressure. That reality will persist regardless of headlines. As this process continues, the market will become less forgiving. Mistakes will be costlier. Access will matter more than timing. Preparation will matter more than prediction. The paper era taught participants to trade symbols. The physical era demands understanding systems. Silver is signaling that shift clearly. The question is not whether the market will adjust. It is whether you will adjust with it or react after it has already done so. Stay grounded. Stay analytical. Watch what moves, not what is said. The structure tells the story long before the price does. That's where the real signal lives.